A very good morning, treasurers. This is your host Parthesh Shah, co-founder of Fintech, and you are listening to Night Snippets. Here is all what you need to know before going into trade for 10th November 2020. In the international market, US Treasury yields jumped on Monday following news that a coronavirus vaccine developed by Pfizer and BioNTech is proven to be more than 90% effective in a study. The result was much better than the market was hoping for. White House coronavirus advisor Dr. Anthony Fauci has previously said that 50% or 60% effectiveness would be acceptable, and these two are 90% effective. With the vaccine enthusiasm, US 10-year closed 13 basis points higher at 0.96 percentage points, and 30-year also closed 13 basis points higher at 1.73 basis points. In Europe, investors also dumped Eurozone government bonds on Monday, and there also yields surged. The German benchmark 10-year yield rose 11.5 basis points to minus 0.50 percentage points, staggering its biggest rise since March. Summary: yield across the world are increasing as investors are now shunning and dumping safe havens, and rush to riskier assets will be seen. Government bond yields in India will also increase, and we strongly advise clients to book whatever profits they can and sit out for 2 to 3 months until the new budget comes in FY21. Remember, we had been a vocal advocate of US yields touching 1% soon, and with US presidential election and vaccine news, this will be the new norm, and 40 basis points increase in US yields has already taken place. India will be just behind US, but yields will increase for sure. We also expect US government to cap the yields somehow, as they can't afford very high yields with the mammoth borrowing plans, but yields are definitely not going back to 0.55 levels anytime soon for sure. Savvy investors will now invest above 1% level in US 10-year yields. If we speak about crude oil market, crude is now trading at $41.86 per barrel. COVID-19 vaccine effectiveness will be bullish for the crude oil market as well, and long-term investors can now look at crude with $50 per barrel target. Crude's short-term range would be $41 to $43 per barrel. In the currency market, dollar index is now at 92.78. A dollar index yesterday saw a low of 92.16, and from there on it has reversed. DXY's today's range seems to be 91.75, which is a strong support to 93.27. An intraday low of 92.12 will signal a downward pressure and will try to bring it back to 90 levels. Our night's house view is that dollar index, after stimulus granted by Senate, will inch much lower, but that will take a while, as Republicans are now holding Senate, which has to pass further borrowing, and they are not in favor of further debt. USD INR with a low of 73.80 closed at 74.12 yesterday. USD INR's range for today will be 73.85 to 74.10. Remember, we spoke about short USD INR trade having some juice left to touch 73.80 yesterday only. It just made a low of 73.80 yesterday and inched back to 74.12. Again, how accurate Knight's predictive quant models are. In the domestic market, government bond prices ended steady amid thin trade volumes as market participants were cautious ahead of the CPI inflation print for October due on Thursday. CPI in September was 7.34 percentage points. Let's do the CPI inflation scenario analysis. If CPI comes in at 7.2 to 7.5 range, markets will have muted response and no major jerk is expected. If CPI reaches near 8%, or which is highly unlikely scenario, then there will be a sell-off in the bond market and the 10-year will try to breach 6% levels. If CPI is well below 650 levels, a low probability event, we may see a small rally in bond prices as traders will start pricing next rate cut possibility soon in few months. The sharp increase in the global yields will also have an impact on the Indian bond markets, as we will also see our 577 GS 2030 touching 590 levels soon, maybe today. 90% effectiveness in latest trials are a very strong promise, and if Joe Biden is able to clinch a larger stimulus, US yields are bound to be 1 to 1.25 percentage mark soon until Fed caps it. Also, India is recovering steadily, and once the credit offtake improves, we strongly believe that Indian 10-year yields are bound to increase, which has been kept captive by RBI lately. Our recommendation is, we already had recommended to sell SDLs at 640, 645 levels 2 weeks back. Now, if vaccine becomes a reality, we want you to sell your long duration bonds as well for next 6 months. The 10-year yields may inch up 30 to 50 basis points very soon, and we should keep a keen eye on global yields, COVID-19 vaccine, credit offtake, and growth revival in India. SDL auctions are there today, and we advise our clients to stay away for a few months if you want to stack SDLs for holding. If your intention is only 2 to 5 basis points in auctions, then you should proceed with tail bidding. If you wish to optimize your bank treasury, help the profitability of your bank in this tough operating environments, and make your treasury future growth ready, then you may contact us at 9930307466 or research at knightfintech.com.